the asset paying you every time you drive. Have you ever driven down a highway and wondered who actually owns that road? Not who maintains it, not who patrols it, but who profits from it. Because every time you slow down at a toll booth, every time your license plate is scanned, every time a truck passes through an express lane, money changes hands. And most people assume that money goes straight to the government, but in many cases, it doesn't. In fact, ordinary investors, people just like you, quietly earn income every single day from highways they may never even drive on. Not through speculation, not through trading, but by owning small pieces of the infrastructure that millions of people rely on daily. And today, I'm going to show you how toll roads became one of the most stable cash flow assets in the world, why institutions and pension funds quietly love them, and how this same infrastructure mindset applies far beyond roads. Later in this video, we'll also look at why this system-based thinking is now being applied to digital assets, and how some investors are using it to build income streams that don't depend on market timing or daily decision-making. Most individual investors are trained to think in terms of price movement. Buy low, sell high, watch charts, react to headlines. But institutional investors, the ones managing billions, think very differently. They focus on systems that produce cash flow regardless of sentiment. Highways are a perfect example. No one drives because they're excited about tolls. They drive because transportation is essential. Every commuter heading to work, every delivery truck moving goods, every family traveling between cities, they all participate in the same system. And the key insight is this: you don't need people to love an asset. You just need them to use it. This is why infrastructure investing has quietly outperformed many trend-driven strategies over long periods. No hype cycles, no overnight booms or busts, just steady, compounding usage. In a moment, we'll break down exactly how private toll road ownership works and why governments often prefer this model. Most people are surprised to learn that thousands of miles of major highways are privately operated. Here's how it usually works. When a government needs new infrastructure, it often doesn't want to raise taxes, increase public debt, or manage decades of maintenance. So instead, it enters a concession agreement. A private company agrees to finance the construction, build or upgrade the highway, maintain it to strict standards. In exchange, that company receives the exclusive right to collect tolls for a fixed period, sometimes 20 years, sometimes 50. In some cases, nearly a century. During that time, traffic flows. Tolls are collected. Operating costs are predictable. Excess cash is distributed to shareholders or reinvested. From an investor's perspective, this is very different from traditional businesses. There are no customer acquisition costs, no brand competition, no seasonal demand swings. Once the road exists, usage becomes habitual. Next, we'll look at real examples of where this is already happening and how much money these roads can generate. Let's make this concrete. Across Europe, large infrastructure operators manage entire national highway networks. In countries like France and Spain, private operators control thousands of kilometers of toll roads. Traffic volumes are measured decades in advance. Pricing structures are often indexed to inflation. In North America, the model looks slightly different. You'll often see privately operated express lanes, congestion-priced routes in major metro areas, long-term concessions tied to urban population growth. In fast-growing regions, especially in parts of Asia and Latin America, highways are still being built at scale. Here, private operators benefit from rising vehicle ownership, expanding trade routes, long-term urbanization trends. What all these examples share is predictability. Unlike a retail business, a toll road doesn't depend on consumer preferences. Unlike tech, it doesn't become obsolete every few years. Unlike real estate, it doesn't suffer from vacancy in the traditional sense. Traffic doesn't move out. But how does this compare to something investors know well, like rental property? That comparison is more revealing than most expect. Many investors in their 40s and 50s already own property, so this comparison matters. With real estate, income depends on tenants paying on time, ongoing repairs, local market conditions, active management decisions. With toll roads, there are no tenants, no lease renewals, no vacancy cycles. Revenue is tied to movement, not occupancy. And here's the subtle but important difference. People can choose where to live, but they can't easily choose not to travel. That doesn't mean toll roads are better than real estate. It means they behave differently. For investors seeking stability, lower management intensity, inflation-linked revenue, infrastructure often plays a complementary role. Of course, no asset is perfect. In the next section, we'll address the real risks calmly and honestly. Every investment has risk. With toll roads, the main ones are economic slowdowns. Traffic can dip temporarily during recessions. Regulatory pressure. Governments may limit toll increases or renegotiate terms. Construction or expansion delays. Short-term cash flow can be affected. But notice something important. These risks tend to be slow-moving, visible well in advance, often shared with governments. This is very different from sudden earnings collapses, competitive disruption, or technological obsolescence. In many cases, governments actively support private operators because keeping highways operational is politically and economically critical. Now we're going to zoom out, because the real insight here isn't just about roads. The real reason toll roads work as investments isn't concrete or asphalt. It's the system behind them. Once built, usage repeats automatically. Payments occur without persuasion. Revenue flows without constant oversight. This is the part most individual investors overlook. They spend years chasing better stock picks, better timing, better predictions. Institutions focus on assets that work quietly in the background. And this way of thinking doesn't stop with physical infrastructure. Today, there are digital systems built on the same principles, not hype-driven, not trend-dependent, but usage-based. If this build once, earn repeatedly mindset resonates with you, there are structured frameworks that teach how to apply it in digital environments without relying on daily hustle or speculation. I'll mention one shortly. Think about a YouTube channel for a moment. Each video is like a small piece of infrastructure. Once published, it can be accessed repeatedly, generate traffic for years, produce income long after creation. The viewer becomes the traffic. The platform becomes the highway. The monetization system becomes the toll. But just like physical infrastructure, success depends on structure, not effort. Random uploads don't work. Chasing trends doesn't work. Consistency without systems burns people out. This is why structured education matters. One program that teaches this system-based approach particularly well is Tube Mastery and Monetization. It doesn't focus on viral tricks, daily posting pressure, or personality-driven branding. Instead, it focuses on building repeatable digital assets, designing channels like long-term infrastructure, letting systems do the heavy lifting. It respects your time. It treats income as an asset, not a hustle. And it aligns with the same thinking institutions use. There's a link below if you want to review it at your own pace. No urgency, no pressure. Whether in physical or digital infrastructure, the framework is similar. Smart investors look for long usage horizons, predictable demand, controlled costs, systems that don't require daily decisions. They diversify across regions, asset types, revenue streams, and most importantly, they think in decades, not quarters. This is why infrastructure investing is often described as boring. And boring, when done right, is powerful. We'll wrap up by returning to the original question and why it matters more than most people realize. Every time you drive on a toll road, you're participating in a system. Most people only ever experience it as a cost, but a small group experience it as income. The same is true across investing. Some people chase movement. Others quietly own the systems people rely on every day. The question isn't whether people will keep driving, or whether digital traffic will continue to flow. The real question is, will you remain a payer or become an owner? If this perspective helped reframe how you think about investing and income, subscribe for more system-based wealth content. Explore the resource linked below if digital infrastructure interests you. And leave a comment sharing which highway you drive most often. Because there's a chance you could already own a piece of it.